So what a horrible day it was in the stock market yesterday, and it looks like we could be heading towards the worst November in the stock market since 2008. It's pretty incredible that, isn't it? I wasn't going to make a video today. I was going to have Friday off, I was going to have Saturday off, and then I was going to celebrate the 20,000 subscribers on the Sunday, but I thought, you know what, I'm going to make a video after what has happened with the sell-off at the moment, and potentially the worst stock market since 2008 for November. But sometimes it's not great going through the dips. But I gotta say, sometimes it's a badge of honor. When you get to go through these crashes and you make it to the other side, it does give you so much more confidence when you do go through the dips. Like if it's your first time going through a dip, you're like, oh no, this is horrible. And you guys that have seasoned, investors that have gone through many dips and even went through that 2022 stock market crash, you're like, this is nothing, guys, don't worry. And it's a little badge of honor, and it does, when you do go through these dips, it does 100% make you a better investor. So yeah, it will improve you in the long term. But yeah, incredible, isn't it? I was quite surprised by that. I generally thought like we would have had a worse November than this since 2008. But then I looked at the dips that we have had previously, and yeah, none of them actually are in November, to be fair. Like the COVID was in like March and April, wasn't it? And the tariffs was the same, and that 2018 dip was like December time. Yeah, none of it actually lines up with November, which is pretty incredible. Normally, I guess we're having a Santa rally, and it certainly looks like Santa Claus is being put on hold at the moment. But I mean, the S&P is only really down about 5% at the moment, which really isn't a significant amount, really. But you look at the S&P 500 and it looks like a lot of the AI boom has held that up a lot at the moment. I say quite often, you look at outside the S&P 500 and there is a lot of companies getting absolutely whacked at the moment. And this is what I say quite often, and people don't realize this when it does come, until it comes to it, is that when the S&P drops 5%, you watch some of the stocks, some of the other stocks will drop 10, 15, 20%. And that's certainly been the case. And I would say even bigger this time, we have a disconnect where the S&P looks like it's having a small dip, but the opportunities that are being created from this dip are pretty impressive. And I'm going to share a couple of them. I think I got 5 for you today that I think are, really cracking opportunities right now to be looking at with the dip that's currently being on at the moment. Now, just a quick little shout out, to be fair. The Black Friday deal, I've had so many messages from you guys. I just had a little bit of a break replying to them. So I'm going to try and get back to them tonight, and I will try and respond to people that want to sign up for the Black Friday deal. Thank you so much for the people that do want to get into the private group. Obviously, a great time. These are the times where you make the most money, is buying quality stocks on dips and surround yourself with a good investing environment. So great time to get into the private group, guys. £44. What you get, a few people have sent me an email like, what do you get in there? You get 100 exclusive videos, Discord with 600 members on to talk about stocks, including me, and what I'm buying and selling in real time on there. So if you do want to join, send me an email, jkrinvesting@gmail.com. I think last year we had about 108 of you guys take up the Black Friday deal, and I think today we're probably going to cross the 108 mark, and it runs until the 1st of December. So yeah, it looks like it could be the best ever one, which is great. So thank you for the record support there. And also on Instagram, just want to share this with you. I'll try zoom in when I do the edit, but I thought this sums up the NVIDIA, AMD and OpenAI situation going on at the moment.
And speaking of money, how about the $20 you owe me?
Oh yeah? Well, I only got 10, so here's 10, I owe you 10.
Thanks.
Hey, Mo, you owe me 20.
Well, here's 10, I'll owe you 10.
You owe me 20. Here's 10, I owe you 10. Here's the 10 I owe you.
Here's the 10 I owe you.
Here's the 10 I owe you. Good, now we're all even.
There's a funny few circles going on, isn't there, with all that AI partnerships at the moment. Anyway, worst stock market since 2008 for November. I was surprised. I was surprised to see such a sell-off yesterday. I thought we had NVIDIA reported their earnings. The stock bounced off their earnings, and I thought that's just going to lift the whole market. That concerns around the AI situation might just calm it down a little bit now with the earnings they brought out, and they were fantastic, to be fair. A nice EPS beat, revenue growing at 62% year over year. And, you look at the comments as well from Jensen, and he said demand keeps accelerating at the moment. A massive hike up on the guidance as well. And I thought, okay, people concerned about the AI valuations, which, to fair NVIDIA, 39 times forward earnings for a company growing at 62% isn't terrible, is it? And I thought that's going to just like calm the AI nerves around, and it went positive, and then it sold off, which is to me standing out as a major sign of weakness there in the markets. Then we had Walmart. Walmart came out with their earnings. Stock had a cracking day yesterday, up 6%, and they beat top and bottom line, and then they hiked up the guidance and all those concerns around the macro environment, the consumer not going out and spending, and Walmart come out and say people are spending. Look, we're going to hike up our guidance. So the combination like Nvidia coming out and Walmart earnings from the macro point of view, I thought that's going to calm the market down. And then on top, you had the US jobs data come out, which saw a surprising jump in September after the poor summer data. And then you're thinking, okay, you've got the perfect combination where AI numbers look strong still. A big consumer business come out and hiked up the guidance, and then job data came out good. And the fact the stock market dipped on yesterday, wow, that's a real concern around that. That's a major sign of weakness right there. And I think ultimately I saw this quote on CNBC, and this kind of summed it up perfectly. It's taking the market a while to sort of digest where it wants to position with regards to the growth versus the value trade, and with exposure to risks versus risk off. And I think that is the case. Now look at the S&P 500. We're still trading at very high valuations at 29 times earnings. And if that is going to happen, we need to have a perfect situation lined up where macro data is still good, AI stocks are still booming, the Fed is still cutting interest rates. We need the party to keep going. The problem is if one person leaves the party, how many other people leave the party? And then we have the stocks, starting to, slow down a little bit. And it seems like the talk on the market is the federal rate cut. People talk about, is the Fed going to cut rates? And it seems like at the moment it's probably slightly in the favour that they might be holding. There's still a chance they might cut, but it looks like the Fed seems to be tilting towards holding the rates at the moment. And I thought, how long is it until the Fed rate decision? Because with the talk so much at the moment, I thought, okay, it's going to be like next week. And I actually looked, and the next meeting for the Fed isn't until the 9th, the 10th of December. So you've still got a good 3 weeks to go. So if we're going to wait 3 weeks for the market to decide on where it wants to go from here and wait on the Fed decision, that's quite a long time of the market kind of being a bit nervous really, which I thought is probably not great to have the market thinking about that for the next 3 weeks. But I also thought, and this does happen, if you want to put more pressure on to get a rate cut, what do you do? Well, to get more pressure, what you do is you get the stock market to go down, because that is, even though it shouldn't, the stock market shouldn't be an indicator of if the Fed should be cutting or not. It is. If the stock market is highs, the Fed are more reluctant to cut rates. If the stock market is down 20%, the Fed will cut rates because of that. And even though the stock market shouldn't be an indicator about if the rate should be cut, 100% that happens. I'll tell you right now, if the stock market was down 20% right now, would the Fed be cutting rates, or more likely be cutting rates? 100% they would. So is the stock market and the big money playing the game of going, well, you're a bit 50-50 about cutting rates? Let's put the stock market into a correction and see if that just tilts you into the right direction. And that could simply what is going on right now. And we'll see if that's the case. Now, ultimately, like I say, I'm not really bothered. I'm just here trying to make money in the stock market. If I buy great companies and I hold them for 2, 3, 4, 5 years and they keep financially crushing it, I'm here to make money. So let the stock market do its short-term things and I'll capitalize for long-term and make money. And I made a longer video around the mindset on what to do in dips in this video here. So go give that a watch as well if you've not given it a watch, and that's going to go a bit more in the mindset. But just to briefly repeat a couple of points that I said in that video there about right now in the stock market. These are the key things, okay? Remember why you invest. You invest in for great companies, growing financials at great valuations. Don't stay at share prices. So many people right now get caught up on logging onto the counter at 15-minute and going, oh, it's gone down again. You're not bothered. You're not investing for where it's going to be in 15 minutes. If all you need to do is go on your look at the valuation, look at the share price. It's good value. Buy. That's it. See you in a bit. You don't need to be looking. So many people get caught up and checking the counts all the time, and it builds pressure on them. This is why you can't get too caught in the good days, and you're not when you're having the good days, you're not checking every 15 minutes and screenshotting and going, oh, look at this. Because when you have the bad days, you know, you don't want to get in the system where you're looking at your portfolio all the time. You buy great companies, lock it away, don't think about it. And that's what I'm doing right now. I've not looked at my portfolio, I think, for the last couple of days. And the only time I've been on is to put a couple of buys in. And I've just bought it, looked at the share price on Google, not even looked at how much I'm up and down, because I have a rough idea. Bought it, locked it away. And that's it. That's all I need to go on for. And then I'll come back when these stocks rally up, and then I'll have a bit more of a longer look and look at the gains from buying in this dip. And that's the key things to be doing right now. You know, so many people get caught up in panicking because of looking all the time. You don't need to look. You're not buying for the next 15 minutes. You know, come back in a year, 2 years time. So that's 100% the key thing to be doing right now. But like I said, with the S&P being down 5%, it's incredible what that's done to some individual stocks. I told you guys before, like, you know, when you have these stock markets and they dip 5-10%, people don't realize, like, the individual stocks, some of them are dropping 30-40% in that time frame. But what's been more impressive this time round is that this 5% in the S&P 500, it has created some absolute mega opportunities in the market right now. I mean, look at PayPal. PayPal's now with the $58. Incredible. Last 5 days, down 9%. So where the S&P is down like 5% in the last, well, not even that really if you go top to bottom. But from the highs to where it is at the moment, it's down about 5%. That's put PayPal down even more. Look at Adobe, the last 5 days, down 6%. Incredible. Year to date, Adobe's down 29% at the moment. Look at Mercado Libre, 8% down yesterday. That's incredible. One day in Mercado Libre's down 8%. I mean, we've talked about PayPal a lot on the channel before. We've talked about Adobe before. But Mercado Libre is an absolute fantastic company. You know, growing at, how fast they're growing again? 39% a year. And I think it's because of this drop now. It's like 38 times forward earnings or something. Incredible. Hims and Hers. You know, that 5% drop in the S&P 500 has led Hims and Hers to drop 35% in a month. And now Hims and Hers is looking at a pretty attractive valuation. I mean, what was the long-term guide? 2030? Was it 1 billion in EBITDA? Well, if they get to 1 billion in EBITDA on a 7 billion valuation and they're growing at 20-30% a year, 7 times EBITDA. I mean, last time we saw something like that was SoFi. And SoFi was trading like 10 times EBITDA. I remember saying to you guys, like, guys, SoFi should not be 10 times EBITDA. You're talking 20 times minimum, maybe even 30 times. So if we get to 2026 and Hims and Hers is doing that levels there, I mean, you're going to be talking the potential that Hims and Hers has returned over 200%. That's without even factoring a premium. If we start talking to the point of view that they trade at 30-40 times EBITDA, then all of a sudden from these sort of levels here, you know, you're getting to nearly 4 or 5x from here, which, yeah, incredible, isn't it? And there's plenty more I could do. You know, there's so many stocks at the moment that are looking so interesting. I mean, I've not even brought Money.com up. I've not brought Shift4 up. Shark Ninja at the moment. Some really interesting opportunities out there. But yeah, just wanted to cover some of the stuff yesterday, what happened, and what could potentially put us on the path to the worst November since 2008. The fact that there was actually so much good news out there for the markets yesterday, and yet it still reversed. That's a big sign of weakness. But positive news that, you know, we did get some good news, but shows where the market's at. And obviously the talk is the Fed rate cut. So if that's the case, are we going to be trading sideways or even downwards slightly until that point, potentially, at the moment? And then also, you know, why could the market be dropping even with such positive news? Maybe the game of putting the pressure on the Fed is what they're kind of trying to do here. But what it is creating is, like I said, you've got stocks out here that where the S&P's dropped 5%. So you got some opportunities out here where individual stocks are down like 30-40% right now, which is the times you want to be buying. And what's been really surprising as well is just to see the S&P down like 5%. Normally you would get these drops in some of these individual stocks when the S&P is down like 10-15%. But the fact you're getting them now at 5% drop is pretty impressive, which really does show at the moment, and we've talked about it before, the big disconnect that is going on at the moment between like the S&P and the Mag 7 and the rest of the market. There is a major disconnect going on there. But hey, like I said, all it's doing at the moment is, if you're long-term investor, it's creating great opportunities, great valuations. So maybe take advantage of them. Anyway, hope you enjoyed the video, guys. See you in a bit.